Retail chartists often identify strong support by pointing to a price level that has been tested 5, 6, or 7 times. This relies on the assumption that time spent at a level equals structural strength. The intuition is that if price bounces off a specific zone for hours, the floor must be solid. Traders often treat this sideways grind as a concrete foundation and load up long positions. Inside institutional routing engines, prolonged time at a level signals a battlefield where resting liquidity is being exhausted. This model illustrates the mechanics of the order book. On top, we see price repeatedly returning to the support line. The bottom half shows the resting passive buy limits, which are absorbed every time price returns to that level. As the market finds consensus, sell-side pressure matches the buy-side limits, filling those orders until they vanish. Each successive bounce wears the floor thinner. When that liquidity is exhausted, the resting bids disappear. This allows a single aggressive sell order to imbalance the book, flushing price downward and triggering a massive wave of retail stop-loss executions. Prolonged time at a level creates a ticking time bomb of liquidity exhaustion. Markets operate in two distinct auction states. The first is price acceptance, or state 0, where price grinds sideways in a prolonged horizontal consolidation. In state 0, buyers and sellers have reached consensus. The auction centrifuge stops, creating a rotational balance where institutions continuously exchange size at fair value. This y-axis volume profile generates alongside the price chart to track consensus. As candles overlap horizontally, a thick ledge of volume builds outward, forming a high-volume node. This ledge is the footprint of commercial consensus. The market absorbs all passive limit orders in that tight corridor. The high-volume node acts as a battery, storing massive kinetic energy as participants enter the consolidation. When a large institutional market order imbalances this loaded book, price avoids a simple bounce, instead executing a high-torque breakout right through the outer boundaries. Breaking the state 0 consensus violently releases that massive stored energy, completely liquidating the participants trapped inside the tight range. Systematic operators follow strict tactical orders to avoid fading or countertrading the boundaries of a high-time consolidation. These ranges are built to be broken. The opposite extreme is true rejection. This state is defined by extremely low time at level. True rejection occurs in seconds because there is zero consensus at that price. The market refuses to transact there for more than a few micro-rotations. On a volumetric chart, price plunges into a clean pocket, a low volume node. The instant it hits that lower coordinate, it snaps back, leaving a long visual wick. This happens when dense passive limit orders instantaneously absorb aggressive selling. Price performs a rapid structural bypass, draining liquidity without lingering to build a volume ledge. This engineered move allows market makers to sweep retail stop losses, triggering a flush of panic selling to fill their own books at a deep discount. Once the liquidation sweep is complete, the asset is aggressively repriced back upward as the market rejects the lower valuation. A low-time wick piercing a low-volume node provides visual evidence of an institutional liquidation sweep, marking a high probability zone for a structural trade entry. Relying entirely on visual price action creates significant execution risk. For algorithmic operators, sight alone is insufficient to confirm these wicks. We sanitize these rejection signals using a telemetry filter, the volume EMA baseline. Consider two identical wicks. On the left, wick A's volume bars remain tiny, below the EMA line. This is ghost volume, a false signal suggesting a lone liquidity drift where price moved without a structural battle. On the right, wick B features a massive volume bar spiking above the baseline, printing a volume surge diamond. This is the verified signal, supported by a transaction explosion. A volume surge diamond indicates that massive participation has met the price at that boundary, signaling that institutional scale volume has stepped in to defend it. A visual low-time wick is only actionable when sanitized by a volume surge. This surge validates the level as a high probability zone for sniper entries. Market microstructures operate in binary regimes. An asset is either lingering horizontally to build consensus in price acceptance, or it is rapidly defending boundaries in true rejection. These regimes define our rules of engagement. High time at level dictates that you do not fade the move. Low time at level signals a ready sniper state. During high time consolidation, an operator's edge is negligible. It is an absolute imperative to lock your hands while the market churns. The retail crowd will destroy their capital fighting over the illusion of support inside high-volume nodes. Your execution systems must ignore the noise and wait exclusively for lightning-fast liquidation sweeps. Successful execution requires the precision of a predatory dive, capturing the exact moment that structural market momentum completely reverses. These entries are reserved for empty, low-volume nodes, cross-verified by volume surge diamonds. Long-term success requires trusting order book mechanics over visual retail illusions. Protect the machine, wait out the acceptance phases, and hunt for high asymmetry rejection nodes.